This is the simplest trading strategy you can employ when trying to make money out of crypto. I've employed it myself within crypto and way before when I was trading stocks. And I'm going to show you exactly how to use this and take as much or as little risk as you want. Crypto is an asset class with growth. We're going to take advantage of it. I'll show you exactly how to map it as well and take advantage of price cycles. So this is a very simple strategy to let the market work for us. And there's two ways that we can trade with this strategy. So the first is much longer term, just taking advantage of real growth in crypto. Very, very simple. The other is to take advantage of the shorter term price cycles that happen. And so we'll look at both of those ways in this video. And I'm actually going to teach you how to know which part of the cycle that we're in, when to take risk, when to actually take profits and pull back a little bit. So the strategy really relies on the fact that crypto is growing and it has fairly volatile price movements. Now that is actually what we need to make investment returns. If it wasn't volatile, it would just go like this and there'd be no investment returns to be made. But we have to know where we have an edge with trading. Now, I don't think we have an edge in day trading, right? Trading on the 5-minute chart, trying to scalp out the market. There are returns to be made there for sure. We're not going to cover that in this video. We're going to look at a very simple way of letting the market work for us. So what we're going to do is we're trying to take advantage of slightly longer term price movements. So when we look at price cycles, Bitcoin moves in a very distinct 4-year cycle. So we're going to take advantage of that. And then the longer term trend of just Bitcoin going up in price over the long term, we're going to take advantage of that as well. So our trades are going to look around 6 to 12 months, not 6 to 12 minutes, right, or 6 weeks, right? We're going to do 6 to 12 months for a trade. We're always going to look forward for 6 to 12 months and see what is the price going to be in 6 to 12 months. Can I make a trade now for 6 to 12 months, actually getting out of that trade? The other is our investments are going to be 6 to 12 years. This is the most important thing. Don't let crypto pass you by trying to trade the market. This is very, very different. Crypto has growth. We want to join that growth and take advantage of it. But trades can obviously make our returns higher if we want to take that risk, but we don't even have to because of how much growth is in crypto. So these are the two things, basically 1 and 2, investment and then taking advantage of price cycles. That's it. The reason these price cycles occur is because really what they're pricing in is fiat currency debt cycles. We all know the price of Bitcoin, right? It's priced in dollars. There's two sides to every trade, Bitcoin or crypto and dollars. These price cycles happen because of the fiat currency, not the crypto. So there's two things, right? We're trading fiat currency and prices, that's one. And then we're investing in crypto. That's because it's growing as an asset class. So those two things, it's actually very, very simple to take advantage. And the returns potentially are absolutely insane compared to anything else. The 21-year price forecast for BTC, 21 to 29% average rate of return or annual rate of return. So that's our base case. Then if we want to trade, we try and outperform that. There's lots of returns here that we can make, and it's actually very simple to take advantage of it. Depending on your trade level and experience, you may use this strategy in different ways. So for beginners, I highly suggest just trading in the spot market. That's where you use cash to buy and settle crypto. You buy the crypto, you invest in it, you hold it, and wait for the performance to come. Now, as you get a bit more advanced, you may want to take advantage of cycles a bit more, use a certain percentage of your portfolio to take advantage of cycles and trade a little bit shorter term. And then maybe you're going to be using leverage there as well. The reason why traders use leverage is because with a trade, there's always an entry and a stop loss. That's an entry. And then down here is where the price gets to, where you actually get out of the trade at a loss to prevent further losses. That's how trading works. Now with that, because you have an entry and a stop loss, it means you know the amount that you're going to lose potentially in that trade. And that means that you just have to fund the potential losses for that trade. That means we can take leverage on the exchange and we actually put less down in the trade, even though we may not be taking any more risk. And then we have the extra cash to put into the investment bags and can use that to dollar cost average crypto over time. So it's just about capital efficiency when using leverage. Most people use leverage to increase the risk, which is not what we want to do. We want to use leverage intelligently as well. I'll explain about this throughout this video and who that's suitable for, because for beginners, it's probably not suitable, right? In any case, I trade on Bybit with spot and sometimes on Apex as well, which is leverage and futures trading. This is Bybit's DEX as well. I'll leave links below because you can get a permanent fee discount on Apex and a deposit bonus on Bybit if you can use it. I'll leave all the details down in the description below. There's only two things we have to focus on when trading crypto or anything else. Number one, does the thing that you're buying have long-term secular growth? right? Like, is it just growing over time and gaining more value over time? And at what rate is it doing that? So that's number one we can take advantage of. Number two is, does it have price volatility? Does it move 1% a month like this? No, nothing does that. It has price volatility, and that means we can take advantage of those areas to make extra returns if you want to take more risk. So firstly, let's look at the Bitcoin price. This is the Bitcoin chart. I want to focus on this white line here. This is the 200-week moving average. It takes 200 weeks of price data, plots it, and then each week it refreshes with the latest week and knocks off the week from 200 weeks ago, and you get this line. This is the long-term price movement of BTC over time, currently sitting at around 43,000. So what we want to do is work out exactly where that moving average price will get to with some sort of annualized rate of return, right? It's this that we're looking for right now, the secular growth. So we go back to a price forecast. This is from Michael Saylor. Now, to put this into context, the NASDAQ, which is the top tech companies in the States and some other companies as well, right? The best performing assets, basically, more or less, are growing at around 18 to 20% a year for the last decade. So if Bitcoin is similar to that, or maybe a little bit, higher because it's a bit younger, we could suggest a growth rate of 20 to 29% a year, ARR, right? Annual rate of return. The bull case at 37%. Let's just do 29% ARR, right? You can work this out yourself very easily as well. What you can do is the calculation to work out where the price will be. So I take 43,000, right? Because that's the moving average price of BTC, not the current market price, which is way more volatile. We need to figure out what the moving average price of BTC is and then try and plot that rate of return over time. So you can do 43,000 and then 1 plus R to the power of N. This means the rate, right? So you do 1.0.3 like this, right? So 1.3 to the power of 10 years or 20 years. Anyway, we don't have to do that calculation. What we can do is go to a AI agent and ask what that would be. So I asked, if the ARR of Bitcoin is 30% a year, do the calculation for me. So after 10 years, 592,000 a coin. After 20 years, 8 million a coin. That's a 30% growth rate. It's not going to work out like this. Some years will be better, some years will be worse, but you have to gain exposure to this performance. You don't have to trade. What you have to do is just go in at every single price right here and understand that it's going to take time, patience, and consistency. The three things that basically no one wants, right? They just want some strategy where they get in and out very quickly, they make a few bucks. If you actually want to make real wealth, you have to get in over the long term and do this and take advantage of secular growth first. And then we can try and take advantage of these cyclical price movements as well. I'll show you exactly how I chart Bitcoin so that you can take advantage of longer term trends and shorter term cycles. This is basically my cheat sheet right here. So what I'm going to do is go to TradingView, and then we're going to search for Bitcoin. TradingView is free, so go and use it. I'll link them below. Then we go to the index. I'm going to look at the all-time history index for BTC, basically the price of Bitcoin since inception. We'll just look at the modern history right here. So what we want to do is we want to make sure that we're on a logarithmic chart. If you look at a regular chart, this is what it looks like, right? Pretty crazy, right? But we don't want that because Bitcoin is a long-term secular growth asset. It's actually a network, right? So we want to go to logarithmic, and that smooths out the price and crushes the price scale up here. But it gives us more of a adoption curve for the asset, which is really what we want to look at. So from here, what I do is I just put some curves on Bitcoin's actual, adoption curve, which you can see it happening here, right? So price moves a lot, and then as we get mature, it starts to slow down with its price movements over time. So you want to try and chart this. So it's literally, I just put this curve on like this, which is the kind of lower bound of what Bitcoin is doing, right? And then you can copy and paste that to bring us into a mid level and then a higher level. So the higher level here, like this, and I would curve this off a little bit because Bitcoin is slowing over time. So you want to try and fit this curve a little bit like this, and then you can do it again for the mid level. And this is important because Bitcoin seems to trade within this quite regularly. So what we're doing is essentially now having a higher upper limit where Bitcoin seems to reject from. So you can very clearly see that Bitcoin rejects when it reaches this point in its curve. It's not about price, it's about the trend of its adoption, the secular trend. So when Bitcoin got to this level, that's where it got rejected. And as it comes up, you can see it gets rejected here again, and then we had that rejection here again. So this upper curve is really a level where Bitcoin tends to reject from. And that's because if you think about a trend is essentially that 29% ARR, right? 29% ARR over time. But the price is going to move volatile up and down, above and below that. So what we're looking at really here is the trend of Bitcoin. When Bitcoin seems to come down to this lower level, that seems to be a support level for BTC where it seems to actually bounce back upwards again, right? So you've got 3 areas where it rejects from, and then 3 areas where it bounces from. In the middle, that is kind of the actual trend of the Bitcoin price over time, right? So what I would say is below this, we're looking at very, very cheap Bitcoin in relation to its trend. Right now, this is something we need to be aware of. This is also cheap Bitcoin if you have a 10-year time horizon, right? This is also cheap Bitcoin if you have a 10-year time horizon. But what we're looking at trading now is trying to take advantage of shorter term cycles, right? So this obviously is very, very good value Bitcoin in relation to its midline trend, right? This is obviously very good value Bitcoin in relation to its midline trend. This is obviously very good value Bitcoin in relation to its midline trend, right? Going up to that. So this is essentially underbought or very good value. This is essentially overbought or not very good value in relation to short-term trends. If you're an investor, do not worry about this. If you're a beginner, do not worry about this. You know, invest for a long time, let the returns come out over time. You're going to be buying some high, you're going to be buying some low, but this is the trend. So put this trend on. And then what I did with the other chart is just put halvings on as well. So you can find the dates of the halving like this, right? Put those on because Bitcoin does tend to go up after the halving. It tends to peak out, have a bear market, and then recover again. So you can put that on. And then going back to my price chart, you can see here what I've done is just put these on as well, which are ways to look at the price. So go to a price range here. You can put it on like this, right? So what I do is color them. Red is a bear market. That's from the peak down to the low. Then you have a recovery, and then you have a bull market up from the low to the high. You have another bear market, you have another recovery, you have a bull market. You have a bear market, you have a recovery, and you have a bull market, right? So you can plot those on. This is important when trading because we need to know when to actually take risk and get into a trade. It's also important when investing, right? Because you can see how these trends play out. You can see firstly that Bitcoin is in a massive uptrend, right? And so does it matter when the price goes down or goes up? No, 29% a year, 29% a year, 29% a year. If you're investing, that's what your portfolio is going to do over time. When you're trading, you can actually use these market phases to time entries better if you're looking to take advantage of volatile price moves. This right here, this white line, go to indicators, type in moving average, simple, click this on. It's this one right here up at the top. You can go to the settings. I've just put this in white. This is essentially, like I said, the 200-week moving average. If you bought Bitcoin every single week, your cost basis and your portfolio would be costing $43,000 right now. And Bitcoin's currently at 93,000, right? So your cost basis when buying now is going to be going up. And then when the Bitcoin price comes down, you'll be getting reducing some of your cost basis as well. But that's what we're looking at as an investor, this white line. So if your portfolio, if you were a trader, big bad trader in the market, and you made 29% a year, and your portfolio, white line just went like this, you'd be one of the best traders in the world because Bitcoin investors have outperformed every trader, every hedge fund just by buying BTC. That's what their portfolio has done. So we want to take advantage of that, right? Investing and making sure that we actually buy when the price is relatively cheap in relation to its trend. So they're the two things that we use. Now, when trading actively, then we get way more active in terms of trying to trade these movements within cycles as well. Now we'll come to trying to take advantage of these cycles to make extra returns. So we have a simple strategy here that you can use, right? So everything is mapped out beforehand. The first one being we have investment and trading, and they are not mixed. Again, I would say 90%, or if you're a beginner, 100%, just invest, buy spot, you're going to get those great returns. And then as you get more advanced, you put a small amount of your portfolio to trades that work out. That can be taking advantage of cycles. It can be individual trades, individual altcoins, or individual stocks that you might like, whatever. But I think the bulk for all of us should be just invest in the best asset in the world that's growing at 29%. But from here, that trading, right? What we're actually trading, we're not trading the asset. What we're trading is the cycle. And the cycle is money supply growth and debt. That is what the entire world is priced off. US treasuries. US debt prices the whole entire world. Every risk asset, every cycle is actually a fiat currency debt cycle. That's it. That's what we're trading. And now that we know that, we don't have to listen to all of the nonsense online about crypto this and it's going to zero and all this. No, we're just trading fiat currency cycles, which are actually very, very easy to map out. So the first thing is, because we're trading crypto, we're not just trading the crypto, we're trading crypto versus the fiat currency. There's two sides of this trade, and they're equally as important. For trading short term, we're trading the fiat currency and not the asset at all. So we need to trade the fiat currency, which means we need to know how the fiat currency moves. Money supply changes. It's called M2. You can go and search for M2. I'll leave a bunch of links down below which go through this. So M2 is money supply around the world. The more money there is, that means risk assets are going to go up, right? Because you have, let's say Bitcoin is fixed in price, fixed in the amount that there is, and you have more currency. If currency changes in supply, then it's going to look like Bitcoin is moving in price. It's not moving in price. It's the exchange rate to the fiat currency. So if there's more money in supply, then risk assets go up in price because you have a flood of money into the system. That finds its way into bonds and stocks and risk assets like Bitcoin. As you get a whoosh of this money supply, asset prices go up. It's very clear. You can see it, right? Money supply rising, Bitcoin. Money supply rising, Bitcoin. As the money supply draws down and the growth of that actually goes lower, and it's a relative thing, right? You can see here that money supplies didn't go negative. It just rose at a slower pace. And that means a bear market for BTC because the rate of change is actually coming down, right? So as money supply doesn't shrink, but it grows slower, you get a bear market, and then we rise again, bull market. We actually got a reduction in money supply here. So we got a pretty bad bear market last time. And money supply is now growing again. And so risk assets can inflate again because they're priced in that fiat currency. So that's the first thing. When trading, we're trading debt cycles and money cycles, not the cryptocurrency. You can see the exact same thing here. This is M2 over time. Broadly, as the amount of currency increases in supply, that means that it becomes cheaper in relation to Bitcoin, right? Which means Bitcoin goes up in price. Bitcoin becomes more expensive in relation to a fiat currency because there's more of it. And as you can see, you get a huge move in money supply. And so Bitcoin moves up in price. As we get a reduction, that's a bear market. As we get a move up to the upside, we've had a bull market. So now that we know this, we can just trade these cycles because they happen in around 4-year increments. How do you know when money supply is about to change though? Well, to make this simple, we're just going to look at the Bitcoin chart because Bitcoin is the perfect way to measure what's happening with fiat currency. And it just so happens to coincide with the 4-year Bitcoin cycle. So around every 4 years, what you get is a bear market, then a recovery, and then a bull market. And you can time it. And the reason that it's timed is because the money supply grows and contracts along with the central banks trying to help the governments refinance their debt. All right, so that happens around every 4 years. They go through this couple-year stage where they drop interest rates and they try and refinance. That pushes risk assets up. That creates inflation, and then they have to draw it down for a year. So then you get that bear market again. Now you can listen to the Fed, you can listen to financial news and all that. We're going to keep it simple and just say that these 4-year halving cycles, we get a bull market after the halving for around 12 to 18 months. Then you get a bear market for 12 to 18 months, recovery for around 12 to 18 months, bull market 12 to 18 months. That's how it works, okay? So we're in a bull market right now, and then 12 to 18 months might be another bear market. So we know these cycles exist, and so we have to time them if we're trying to take advantage of them. Let's look at how to trade a cycle then. And again, you can actually choose exactly what you want to go ahead and do here. So firstly, how much of your portfolio are investing versus trading? Right, 90-10, let's say. So 90 is just dollar cost averaging, Bitcoin, NASDAQ index, whatever you want, right? And then 10% is trades. What is a trade? A trade can be going in at a certain price, hoping for the price to bounce, right? So if Bitcoin moves with volatility, so you get expansions and contractions, maybe you're trading price movements. You can do that. Another way to trade is to put this 10% into things that you think will perform well during a cycle, right? So for example, MicroStrategy is basically leveraged Bitcoin. So do you want to buy that at the bottom of the cycle because it's leveraged Bitcoin and you think it would perform well? So that's a trade. Do you think that a basket of altcoins are going to hit a narrative throughout a cycle? And so you have like a basket of them, which is, a trade, right? So you can compartmentalize that. It's like, I'm going to buy, of my trading portfolio, of my 10%, split that into a fifth. 20% of that is a MSTR. 20% is a basket of altcoins. 20% is Tesla. Whatever you want it to be, right? It's up to you what you think can outperform or do well throughout a cycle, right? So that can be a trade. Or it can literally be, I'm going to trade price movements 5 times. I know that the price pulls back at least 5 to 7 times during a cycle. You get an expansion, a contraction, and I'm just going to time entries on those pullbacks to get a decent entry level for a price, hoping the price moves again, right? So it's up to you what you want to do. So the way to do that is just have 5 trades and say 20% each, right? Or if you're trading prices and you know that the price of Bitcoin is underneath its trend, underneath the 200-week moving average, these are typically insane times to buy. I'm going to put more in at these levels because I think the risk reward is better. And so you go and say, maybe 30% is in the first 2 trades, right? So I'm going to trade once under here. And then if we bounce, I'm going to trade once here, right? And then if we bounce and come back, I'm going to trade once here. Well, that's 3 trades, right? 3 entries. And so you may say the first 2, 30% because they're lower, right? They're lower down in terms of Bitcoin's trend rates. And then as you get higher, if you're trading, as you get higher up here, right? Bitcoin is very high in relation to its kind of trend, right? Its trend rate of growth. They're not the best times to go long, right? And so maybe you just put less in there. So again, there's many ways to do this, but some sort of plan and strategy has to be in place. So for me, what I would do when I trade prices, I would enter trades when we're underneath the 200 week because Bitcoin is low in relation to its trend. I would enter trades during recovery, upswing and bull market and not bear market. So what I'm talking about is this area here is time to trade. This area here is time to trade. Anything up here is probably not the best to take long positions, right? You're just trading at just the wrong area, right? You're very overdone in relation to the trend. And so those bull market trades aren't going to work out, right? They're just more risk and less return at that point, which is not good for a trade. Again, with investing, if you actually want to just come off a little bit, you can do. Or if you don't care and you've got a 6 to 12 year time horizon, just let the 29% ARR come out. Use drawdowns. I'll talk about this in a second. Use average drawdowns to guide you where you enter your trades. Trades are win-lose in terms of the position. So you have an amount that you put into the trade and that's your trade and you're happy to either take profits or just lose that trade. And then stop trading and start to get out when BTC price is peaking, right? Which is up here. So when the price is peaking, we really, we don't want to be taking huge long positions in leveraged anything because the bull market's actually maturing here and the price is, it's just a risk reward, right? It's not the price can't go a little bit higher here or whatever, but we're just talking about risk reward here. Up here, it's not the best time to trade long positions and get into bull market trades. When trying to time a trade in a bull market, and that's why I say we need to trade in bull markets and swings because we actually have data on this. Now in bear markets, you get a drawdown, a recovery, another drawdown. We can't trade that to the long side. So we need to trade recoveries and bull markets. And we actually have data that shows us what the average drawdown is. And the data gives us the conviction to go in for these trades. So we know that Bitcoin during bull markets, so recoveries and bull markets, the price goes up and it draws down. Then you recover and draw down. And you recover and draw down over and over again. You have maybe 6, 7, 8 of these in a bull market. These are tradable events. We know since inception that Bitcoin usually draws down 25 to 50% in a bull market correction. It draws down and then it goes again. So that's tradable for us. It also gives us information about where we put our trade that we could get drawn down a certain amount. So we have to know that that can happen and we have to be aware of that. And then we can put our trades in around that. So I'll show you exactly how this would work. Back in my trading system, I can now use that on-chain drawdown data to show me exactly where to place my stop loss with a trade. The reason I would place a stop loss here is because this trading system, I'll be using some leverage on here. And so I would always have an entry and a stop loss just to know exactly what my risk is per trade. If you're trading other things, other stocks or something like that, then maybe you're just buying them with cash and that's your trade. So you're not using leverage and you don't need to use a stop loss or whatever. It's up to you. But for a system like this, we're going to use an entry and a stop loss. So I know that the average drawdown could easily be 30, 40%, right? So we're looking at something like this, which let's call it 60K. So that would be an area where it could pull back and the data shows me that. So if I get in now, that means down to 60K, that would be something like a 35, 33% drawdown from my entry. Now that means that I can use 2x leverage without any issue. The reason being, if I enter now and I use 2x leverage, let's say I've got $1,000 trade that I want to put down. So I put $1,000 into the trade. Well, I'm fully cashed up, so that means the price can go up and down, it doesn't matter. But if I'm using leverage, let's say I'm using 2x leverage. Now I've got a $1,000 trade with the market, but I only need to put $500 in. because you've got $500. The system lets you trade with $1,000, which are, 2x leverage, right? So 500 times 2, that's your $1,000 trade. But you've got $500 there to pay for any potential losses. And so that $500 means I've got an extra 500 to put in DeFi or to use for a different strategy or to invest in spot Bitcoin or anything like that. And what I'm doing here is just putting money on the account to pay for a potential loss. So I have $500 in and 2x leverage makes it a $1,000 trade. That means because I'm 2x leveraged, that $1,000 trade, if it falls 50%, my initial capital is wiped out because 50% move on $1,000 is $500. That wipes out my original capital. It's 100% move my original. To the upside as well, though, if it goes up 50%, then I've made $500, which is 100% of my original capital. But in any case, I'm just using leverage for capital efficiency so that my other 500 can be somewhere else, doing something else. And so what I know is that my stop loss will be here, which is a 35% drawdown on my entry. I can easily use 2x leverage because I would be able to pay for this loss and stop myself out before more losses. And so the system is going to liquidate me when I make a $500 loss. But this would be less than that, right? It's a 35% loss rather than a 50% loss. So that is why I use this drawdown data and stop losses. We need a stop loss in here because we need to know our entry and our stop loss when taking leverage. We need to know how much risk we're taking. But I know that a 35% drawdown, I can use 2x leverage no issue because 2x leverage liquidation's down here and I'm going to stop myself out before that. So the leverage isn't increasing any risk that I'm taking. I can just use a leverage to take more capital out of the trade and put somewhere else. During a bull market, I can put that in stable coins with decent yield in trusted DeFi strategies. I can actually just buy more BTC in the spot market and have it working there rather than here. So that's how to use leverage without taking extra risk. I know that a 35% drawdown is where I'm going to stop myself out. And if I use 2x leverage, it means I stop myself out before the system does. I'll show you exactly how I would enter a trade like this then. So for one of our trades, we split it up into trade 1 to trade 5, 20% each, something like that. So you'd put an amount in here that you're happy to win and lose for this trade, which is a small percentage of your portfolio. So put an amount in here. I'm just going to open a market order to show you, and we'll put an amount of USDT, whatever that is. So what we can do is enter with a take profit and a stop loss. My stop loss is down here. I'll put 60,000, something like that. Then I can go ahead and buy long. We want to use some leverage. So I'm going to click on this, 2x leverage, press confirm. That means that the size of this trade, I just have to put half down in it. If you're using 3x leverage, it means you put a third of the cash down, but it means your liquidation price moves up. So a 30% move wipes you out. If you're using 10x leverage, it means essentially if you've got a $1,000 trade, you put $100 in, but a 10% move to the downside wipes you out. Now I know from the on-chain data, 10% is more than likely, and so that trade is basically going to lose, right? Basically 90+% I'm going to lose that trade. So there's no point putting it in. So small amount of leverage and well within my risk tolerance. So I'm going to buy long like this, confirm, and you have that in. So now I have the entry and I have the stop loss down here, as you can see. You can edit that around as well. So that would be the trade in. Now from here, what you can do with this trade is maybe split this up into 3 separate trades, right? So we know that a potential drawdown could be 30%, anywhere from 15, 30%, something like that. So what you can do is start entering. One trade, you can actually split that up into 3 trades. So rather than having one entry, you could say, I'm going to enter here with a third of that trade. I'm going to enter here with another third and here with another third. The issue with this is that sometimes it won't draw down that much, and you may only get the first third or even the second third done. And then this last third here, it's not there, and you might actually chase a little bit higher. That's up to you. You can either put one trade in once, or you can split it up into different trades. And so you might get better entries. But essentially, what we're doing is buying here and knowing what the average drawdown is for our stop loss, and that's it. This stop loss is miles away, but this is a volatile asset, and I don't want to get stopped out. And this is what the on-chain data is showing me could happen. So that would be how to enter a trade like that. You can also manipulate this and you can add to this over time. Now we'll get to actually exiting these trades. You may see many day trading strategies that want you to get out of a trade at some arbitrary measure like 10% profit or the previous resistance. It's not going to work for cycle trading and swing trading this asset. What we're doing here is swing trading cycles and investing in the asset class because it's growing over time. So what we need to do is look at the price and the trend and the cycle. So the price in relation to its trend. When the price is down here, it's very low in relation to the trend. And that means that risk is very cheap. That's a good time to take risk because the risk reward is very good. As the price moves up, to be expensive in relation to its trend, that is not the time when we should be taking risk, because risk is very expensive and the risk reward isn't good. So look at the price in relation to its trend and its cycle. You know, we're still fairly early in this cycle, but as we get up here, these are areas where you wouldn't really want to be taking new risk. And so these are the areas where you want to start getting out of trades. Again, it's not day trading with an arbitrary number that you want to make. It's just looking for the data, the pullback data, the trend and the cycle data to know when do I take risk and when do I not take risk, and then trying not to get stopped out in many trades. So you can use your experience there. As you know, you move up, you're in the trade. Do you think that's the end of the bull market? Yes or no? If you start to move into this area, that is the area where risk is expensive and you want to be selling risk there, not buying it. So that is trading cycles of BTC. I'll leave some much more in-depth trading guides down in the description, deposit bonuses and fee discounts to the exchanges I use down there as well. I'm James, this is Money GG. Cheers for watching and I'll see you in the next one.